Hello everyone and welcome back. We're now going to illustrate the Goodwill method using the end of chapter 9 comprehensive problem. Previous lecture, remember, was the bonus method. Now the stark difference between Goodwill method and bonus method, as you might guess, is over here in my books of the partnership. I'm going to have an account called Goodwill. Now what I'm going to do is I'll make entries to the Goodwill account when there's an event that warrants that. And like the bonus method, when there was an event and I needed to adjust the partner capital accounts, I did make the entry to the partner capital accounts. But under the Goodwill method, I'm also making an entry to a Goodwill asset on the books of the partnership, and then I'm using the partner accounts to complement that, or to be the credit side of that entry. So let's see what's going on. Right out of the chute, under the initial setup entry, I'm having to record Goodwill. Now where did that amount come from, the $14,000? If you remember, they said Heyman and Mullins they've agreed to have 50-50 splits of the partner capital accounts at the outset. Heyman is bringing to the table $10,000 of cash and inventory, $40,000 of cash and inventory worth $12,000, so that's where Heyman's $52,000 comes in. Now, think about this algebraically. If $52,000 is equal to half of the partnership, what is the total partner capital at outset? If I take the $52,000 divided by 1/2, I will get $104,000. What happened with Mullins Capital? We know we're going to have this equal split here, $52,000 each, but what did Mullins bring to the table? We know there was a building that had an appraised value of $48,000 encumbered by a note payable of $10,000, and therefore the net of what Mullins brought was $38,000. Perhaps Mullins had some qualities, maybe skill set, maybe customers, whatever, bringing to the partnership. Heyman was perfectly fine with saying, I like that, and I'm going to be a 50-50 split with you, knowing that the assets that Mullins brought in were a net of the 48 and the 10, net of $38,000. And therefore, we have to then show this $14,000 of goodwill in order for our opening entry to balance. So that's where that comes from. Now, what other events happen? The $12,000 injection of capital that we see here on row 6 is the same as the bonus method. We handle it the same way, where Heyman is just bringing money into the partnership. Now, the bonus and the interest calculation and the income allocation mechanically are done the same way. The amounts are different, and the reason is we had a different starting capital balance. So you can see Mullins is staying at $52,000 the entire year, therefore he gets $5,200 of interest on the capital account. Heyman, you can see the mathematics going on here, $52,000 for 9 months, and $64,000 for 3 months, and we get a weighted average of $55,000, and therefore a $5,500 interest allocation. These two amounts, the $5,200 and the $5,500, you can see down here as I allocate the income of the partnership. And we also had the $3,000 bonus calculation. Remember the algebra that we did under the bonus method. Now don't think of this, this I know is the same word, bonus, but this is not the same concept as we're talking about when we say the bonus method versus the Goodwill method. So make sure you make that distinction in your mind. This is just a payroll bonus payment that Heyman is getting. So don't confuse that with the bonus method of doing the accounting for these partnership events. Okay, so you see these numbers then rolling in under each capital account, and then you see the subtotals that I'm striking here at the end of 2012. Now what happens, the next event that occurs is we have the $66,000 incoming Lewis, and they say, okay, Lewis, you're going to buy a third interest, a 1/3 ownership. Now don't confuse that with the way they're going to split the profits. That's a different issue. Lewis is saying, I'm being entered into the partnership, and I'm going to be a 1/3 equal owner at this point in time, and I'm going to give you $66,000. Now pay attention here, because that $66,000 implies that the partnership is really worth $198,000. How do I know that? If $66,000 is equal to 1/3 of the entire partnership balance, therefore what is the entire partnership balance? And you can see it's implied to be $198,000. You can see the math going on there. 66,000 divided by 1/3. Well, after that money comes in, the combined partnership balance, you can see here 195,800. I've got a difference of 2,200. I don't want to call it a shortfall because it's actually a good thing. What is that? Well, apparently the partnership has grown, has gotten better, a better reputation, and maybe even Lewis is bringing something to the table. I don't know, but we do know that we've just now we have an event, and it causes us to recognize $2,200 of goodwill because of what's being implied by Lewis's purchase of the 1/3 share. So this 2,200 now needs to go between Heyman and Mullins according to their profit and loss split. So if I take the 2,200 times 60%, you'll see that I get 1,320, and do the same thing for Mullins. Take the 2,200 times Mullins 40%, and I get the 880. And so now my debits and my credits equal, and I've taken the goodwill that I'm going to debit over here on the asset side of the partnership's books, and I then credit my capital accounts respectively as we show. Now, what I'm doing here, again, these amounts under my capital accounts are the same as we illustrated under the bonus method. There's just kind of this plug number, a few years later down the road, this is where the capital accounts are. So I simply plug to get to those amounts, and here we are. Now, what happens at this moment in time? At this moment in time, we have Mullins who wants to exit the partnership, and then that's going to leave Heyman and Lewis as new owners. And of course, then that implies that Heyman and Lewis will then be 50-50 owners. Again, we're going to assume that's the way they may want to split the profits going forward, but they're going to be 50-50 owners at that moment in time. Now, if a partner is exiting whose capital account is $78,000, and the partners agree, and maybe there was an appraisal done, somehow they came to an agreement objectively that the payment for that ownership interest should be $90,000, then I've obviously got a $12,000 difference. Well, what is that? Why would I be willing to pay $90,000 to get someone to leave the partnership when their true capital balance is really only $78,000? Well, that implies that there is some goodwill to be recognized in the partnership. Now, if then I take that $12,000 that represents, in terms of a split, 20%. Now let me make sure we all understand why I'm using the 40-20-40 split to take care of this goodwill that I'm going to recognize. Think of what's happened during these few years, and the partnership, maybe the customer base has grown, the reputation has grown, the name recognition, maybe they got some trademarks out there, and so therefore it's gotten better in an intangible sense. Okay, of course the assets have grown because hopefully the thing is making money, whatever this partnership does. Maybe it's a bunch of lawyers, and so they're making money because their billings are more than what their expenses are, and that's all well and good, and that's going to cause the capital accounts to grow. But also, let's say their reputation is growing and the customer list is growing. Those kinds of intangible assets that would point to a goodwill growth. And so what's going to happen is I'll take, if the 20% share of that growth is $12,000, how much did the entire partnership grow? And that's where I'm going to get to $60,000. I'll take that $12,000 that I know, because I'm going to buy him out at $90,000. And so that difference is 12, and 12,000 represents a 20% share of the growth. Therefore, the entire growth was $60,000. Now, the split, or how I would record that $60,000, because I've got to get Mullins exactly equal to $90,000 so I can cut him a check and send him on his way. The split of that $60,000 is going to go 50-50 between Heyman and Lewis. Why is that? It's because on a go-forward basis, after Mullins exits, Heyman and Lewis, they're at 40-40 before, now they're just going to be at 50-50. So I've got the $60,000, I know $12,000 of that is going to go to Mullins Capital, and so I'll just take the $48,000 difference and split it evenly between Heyman and Lewis. And then you can see I write the check and pay out Mullins. That capital account's down to 0. The partnership legally is dissolved, and I can have a new articles of partnership with Heyman and Lewis going forward. And then you can see what their capital accounts are at that moment in time. And it looks like I do have a formula error here. Let me fix that for you here. We can do just a crossfoot, if we will cross these columns, and we're good to go. So 416,000. Now you can see I don't have all my footing going on here, but so hopefully you'll you know, forgive the formula errors that are going on here, but and focus more on the mechanics of this. And I'll fix this before I post it on the blackboard. Okay. Hopefully this helped make some sense to you, or help the concepts make sense as far as how we illustrate the Goodwill method versus a bonus method. And obviously we are recording Goodwill when the events dictate the need to do that. Okay, thanks for your attention, and good luck with the rest of the chapter.